Hello and welcome to Beyond the Benefits with Savoy Associates. My name is Chris Vanderwolk. I'm the Vice President of Employer Services and Compliance. With me today is Dan McMonigle, our large group strategist. Welcome, Dan.
Thank you, Chris.
Wendy Ebner, our Vice President of Strategic Partnerships. Welcome, Wendy.
Thank you.
And Anthony Lividini, our Business Development Specialist. Welcome,
Thank
Anthony.
you, Chris.
So we're here today to talk about self-funding employer health plans. Dan, what is self-funding in an employer health plan?
Well, self-funding is an arrangement that an employer enters into where they agree to pay for the eligible claims associated with their health benefits. And that payment comes out of their own funds.
Wendy, has this been around for a while? Is this new for employers?
Absolutely not. So self-funded arguably is around longer than it's fully insured. So self-funded has stood the test of time. Most large employers in the nation are self-funded, and we're only now starting to see that come down under 100 lives in different variations, also with something we'll be talking about today called level funded. So new emergence in the down market for sure.
So Anthony, how does this differ from insurance for employers?
So for a traditional fully insured plan, the carrier is assuming all of the risk in exchange for paying the claims. Whereas self-insured, the employer is taking on all of the risk and paying claims as they're incurred.
So we've got risk shifting, we've got cash flow. There's a number of things that we need to work through to think how this works for employers. Dan, what are the mechanics of these plans? How do you manage that risk and the cash flow?
Well, I like to look at it from two perspectives. First, the employee's perspective, and then the employer's perspective. From the employee's perspective, a self-funded plan functions exactly like a fully insured plan. They have cost sharing associated with benefits, and once they utilize those benefits, they pay their equal cost share. Now, from an employer's perspective, it's the way that the premium is different from fully insured. And in a fully insured arrangement, a premium is all fixed. It's one monthly fixed cost. With the self-funded arrangement, you have essentially two different buckets. You have your your fixed costs, and you have your variable costs. Now, your variable costs are your claims fund. So that is the claims that are incurred by the plan or by your employees each and every month, and you pay those as they come in. The fixed cost, you have essentially two buckets there. You have your administrative fees, and then you also have your stop loss fees. And the stop loss is what really allows the self-funded plan to work because it provides catastrophic protection for the employer from the entire group or any one individual of that group.
So you mentioned employees, it looks basically the same. So they get an ID card that has co-pays, co-insurance, deductibles, like they would on a fully insured plan.
Exactly right, Chris.
And safe to say, there's a lot of employees covered under self-funded plans today?
Well, actually, most of the employees in America are covered by a self-funded plan.
And that's because large employers are almost exclusively self-funded, like
Exactly
Wendy mentioned.
Right.
All right, Anthony, Dan talked a little bit about variability with claims coming in on a self-funded plan. What is the risk to an employer under a self-funded plan?
So with a self-funded plan, the risk is really all on the employer at the end of the day. There's a lot more predictability with a level funded plan. On the self-insured side of things, you can have a large claim and have to pay that claim out within a month's time. So the cash flow could really be a concern. Whereas with the level funded side of things, it's broken out within a 12-month span. There's a lot more predictability at the end of the day, and they get to reap some of the benefits of the self-insured platform.
How does the math work in general terms? We know that every administrator is going to have their own rules, but how does the math work for a level funded plan? How do you figure out how much you're paying each month?
So for a level funded plan, it's broken out throughout the year. So there's a set cost that the employer is paying on a monthly basis, and it's really worst case scenario that they'd be paying on that monthly basis. So at the end of the year, if the group is running good and the claims experience is favorable, they would be able to potentially partake within that health rebate at the end of the year.
So for self-funded, if I'm an employer and I'm pure self-funded, I incur a huge claim, $1 million in March, I'm on the hook to pay that in March, maybe April, but really quickly I've got to come up with $1 million. But level funded, you're saying if my worst case scenario is $1 million, I'm going to pay 1/12 of that every month and know that if that $1 million claim doesn't come in, there's a big surplus at the end of the year. I'm going to get all that back. Some portion of that comes back to me. So I went from a huge cash flow issue in April where I need to figure out how to make payroll and pay $1 million claim to I know I've got to pay this every single month. I can budget it. That's the real benefit to going level funded, right?
Correct.
So you give up a little bit of cash flow potentially up front on a fixed level to guard against a huge cash flow hit if a big claim comes in.
Right. And, if you're familiar with self-insurance, you know that we often see an illustration that shows max liability. And what level funded does, it attempts to take that max liability, Chris, and divides it by 12 months to come up with a fully insured looking like rate when in fact it is just a divisor of the max liability.
So I'm a big car guy. I think everybody who knows me knows that. This is a shock absorber. On a car, and we're going to go way off the rails here, on a car, the spring's going to make sure the suspension never fully collapses, but the shock absorber is what keeps the trunk from bouncing up and down as you go down the highway. This is that shock absorber. Your stop loss, as you mentioned, is going to stop the plan from collapsing. The employer is going to pay that $1 million out over the course of the year. But level funding is their shock absorber to slow down the rate at which they have to pay that if they take that hit, if they hit that pothole in the beginning of the year. All right, Wendy. So we learned about stop loss. We learned about paying claims as they're incurred. We talked about fixed costs and variable costs. It seems like it's all pretty straightforward. Is it the same with every administrator?
No, absolutely not. So I'll start by saying, like with straight self-funding, we're not going to talk about level funded in the statement. It's custom, and that's why they're not ever the same. You have the ability to set different stop loss limits. You have the ability to set different contract bases. And what a contract basis is incurred claims versus paid claims. So if I'm to be in a plan and I know that next year I'm going to leave that plan, I need to have run out protection, which means the last day of coverage, the claim hasn't been sent to the carrier yet, right? So that's an incurred claim, but not yet paid. So where some variance totally exists and price follows that variance is when you have either a 12/12 contract or a 12/24. So totally different on the self-funded side, different networks, different access fees.
So if you're buying the cheapest, you might not be buying enough.
Absolutely, and we've seen that quite a bit. On the level-funded side, the concept of protection, as was prior described, is pretty constant. You're paying a 12-month thing, but where the variance exists is in the lack of benefits. So you see some carriers strip mandates out. You see some carriers say yes to autism, yes to infertility, or no. So you have to look closely at the contract and take a look at benefits. Secondly, you really need to be sure that you have a carrier that fits the tolerance for transparency, because frankly, some of the carriers will want individual medical questionnaires filled out on level funded down to a certain size, and that can be a little invasive. When you're a big self-funded group, that all is kept very nicely through claims reports, which are better packaged and anonymous. So underwriting guidelines, effective dates, benefits, this is where the level funded market differs. And then of course, what does the carrier do with that surplus refund at the end of the year if you're due? And is that coming back to the employer in the form of cash? Is it coming back in the form of a claims credit or an admin credit? So a lot of wild variance in the level funded market.
How much is coming back is a variable too, isn't it?
Correct. It's generally 50% surplus refund, but we've seen some carriers be willing to give you 100% surplus refund in exchange for paying a higher fixed cost month over month.
So pay me now or pay me later is really the motto everywhere.
Yeah, that's it.
And now you mentioned taking mandates out of the plans.
Mm-hmm.
How does that work? I thought insurance mandates had to be in the plan.
Yeah, so self-funded is not regulated to the degree that fully insured is. So if a state regulates a mandate, I could use New Jersey as large group infertility, 3-4 rounds of in vitro. Self-funded doesn't need to abide by that. So the beauty of self-funded is often if you work with a carrier, and the larger the group, the more likely the yes to this, they'll customize and match a mandate if you want it. But from a cost perspective, employers are attracted to these plans because the carrier has the ability to pull those mandates out. And now you're talking about a 12-month equivalent rate that looks like fully insured, but has stripped out costs that we in the fully insured side can't get rid of, thanks to regulation.
Yeah, so earlier you talked about the history of this. I remember 10, 12 years ago when we started seeing a lot of self-funded plans moving down market, the market was running around calling these ERISA plans. And that was a bit of a misnomer because every employer plan is an ERISA plan except for a very small segment. And you can come join my class on ERISA some other time. However,
He's going to ask me a question on ERISA. This is your question.
no, I'm just gonna talk. These plans are federally mandated as opposed to state mandated.
Correct.
And so they still have all the federal protections that ERISA gives to employees, but you can get away from certain state mandates. However, that's a double-edged sword, isn't it?
Absolutely. And that comes along with, as we know, the word ACA. Lots of what is required to be compliant under ACA is handled by the carrier. And in the self-funded arena, the plan sponsor has that responsibility. So it's very important also when you're evaluating what combination of creativity in terms of the vendor, the network, and all of it, who's handling those things. So this is one of the things that's so nice about working with a GA is we create grids, we have lots of content that kind of helps you discern where different risks lie with different carrier combinations.
All right, well, that's what stop loss is, that's what self-funding is, that's what level funding is. I think employers have a lot that they can benefit from this, and we're going to talk about that the next time we get together. Thank you for joining us today at Beyond the Benefits with Savoy Associates.